All right, so we are back with OB3. I'm going to be looking at the Trump accounts. So this is part of the chapter we were looking at before, chapter 2, which had the no tax on tips, no tax on overtime, and the deduction of car loan interest. But I've decided to make this separate because it's really different than the other 3 sections of that chapter, and it's pretty involved. So let's jump into it. Let's see. We got HR1 here. So this is part 9, section 70204, Trump accounts and contribution. They're creating a new section 530A, which is what they're talking about here. But basically, we're creating a new type of account in the same manner as individual retirement account under section 408A. But there are certain exemptions to that because retirement obviously applies to retirement, and this does not. This goes from birth through 18, basically. So the account is created or organized by the secretary for the exclusive benefit of an eligible individual or such eligible individual's beneficiaries, or 2 is created or organized in the United States for the exclusive benefit of an individual who has not attained age 18 before the end of the calendar year or such individual's beneficiaries. So the key element is that it has to be open for kids who are, as of December 31st of whatever year you're talking about, are not yet 18. So if they're 17 on December 31st, then they're good. If they're 16, 15, 14 on down the road, that's all good. It can be funded by qualified rollover contributions. It can be funded by able account rollovers. It can be funded by if they have other types of qualified rollovers. So as far as when this all kicks off, no contribution will be accepted before the date that is 12 months after the date of the enactment of this section. So this whole thing was enacted July 4th, 2025. So that means these accounts will be able to be opened July 5th, 2026 and onwards. No distribution will be allowed before the first day of the calendar year in which the account beneficiary attains age 18. So again, going to that December 31st timeline, in the year that the child reaches age 18 during that year sometime, you can begin withdrawals at January 1st of that year, whatever year that might be. So no part of the account funds will be invested in any asset other than an eligible investment during any period before the first day of the calendar year in which the account beneficiary attains age 18. So when they're 17 and younger, there's a very restricted list of things they're going to be able to invest in. After they turn 18, then apparently that opens up. Now, who is eligible? Any individual who has not attained the age of 18 before the close of the calendar year in which the election under subparagraph C is made has got to have a social security number, and for whom an election is made under the subparagraph by the secretary if the secretary determines, based on information available to the secretary from tax returns or otherwise, that individual meets the requirements of subparagraphs A and B and no prior election has been made for such individual under clause 2, or an election is made under the subparagraph by a person other than the secretary at such time and in such manner as the secretary may prescribe for the establishment of a Trump account if no prior election has been made for such individual under clause 1. So if you're listed as a dependent on your parents' tax returns, that has to be consistent. They got to have a social security number, got to be under 18 as of December 31st of the year in question. So that's who can, open, or who an account can be opened for, because these are trustee accounts, just like all IRAs are. Eligible investment. In general, an eligible investment means any mutual fund or exchange-traded fund which tracks the returns of a qualified index, which is defined down here, does not use leverage, does not have annual fees and expenses of more than 0.1% of the balance of the investment in the fund, and meets such other criteria as the secretary may determine. All right, so qualified index is going to be the S&P 500 or any other index which is comprised of equity investments in primarily United States companies and for which regulated futures contracts are traded on qualified board exchange. So basically, it can be S&P 500. We'll probably get the NASDAQ in there, maybe Russell 2000 kind of stuff, maybe, but it's going to be the big indices, basically, is what it's going to come down to. Account beneficiary is going to be the individual on whose behalf the Trump account was established. So here we've defined who can be the beneficiary of the account and what they can invest in. So it's going to be index funds, basically, and it's going to be mutual funds or ETFs. It's going to be primarily S&P 500 type index investments. So I think Vanguard will have a huge market of this, but all the big brokers will have their own versions, Fidelity and Edward Jones and E-Trade, because they all carry those kinds of products very easily. And then once the account is open, what do you do with it? So the idea is to put money into it, right? It's already mentioned qualified rollovers, but then we also have contributions. No deductions allowed. No deduction shall be allowed under Section 219 for any contribution made before the first day of the calendar year in which the beneficiary attains age 18. So what this is kind of implying is that at age 18, it turns into some kind of traditional IRA, at which point those contributions will be deductible. Maybe. Contribution limits, it's going to be $5,000. Here we go, cost of living adjustment. So they are going to adjust the $5,000 year to year based on the cost of living adjustments. Exempt contributions are going to be qualified rollover, qualified general contribution, or any contribution provided under Section 6434. And if you look up 6434, that's kind of your 529s. It's creating that sort of thing. Cost of living adjustments multiplied by cost of living adjustment and year 2026, so on. It's going to be rounded to the nearest $100, which is fine. Timing. So Section 219F3 shall not apply to any contribution made to a Trump account for any taxable year ending before the calendar year in which the beneficiary attains age 18. So while they are minors, you don't get any deductions or anything like that. Distributions. Except as otherwise provided in this subsection, no distribution shall be allowed before the first day of the calendar year in which the account beneficiary attains 18, which, we already talked about as being the inverse of the language before, but they're spelling it out here. Tax treatment of allowable distributions. For purposes of applying Section 72 to any amount, and Section 72 is what creates the 10% penalties on early withdrawals from retirement accounts. To any amount distributed from a Trump account, the investment in the contract shall not include any qualified general contribution. So if you put in qualified money, you can take that money back out without penalty. Any contribution provided under Section 6434, any amount of any contribution which is excluded from gross income under Section 128. So basically, rollovers and the original money you put in, you can take out without hitting a penalty. If you take out other money, like gains from those mutual funds or ETFs that you have, then there are going to be potential penalties if you don't use it for allowed purposes. What is a qualified rollover contributions? There's an able rollover. Paragraph 1 shall not apply to any distribution which is qualified able rollover contribution, and the amount of such distribution shall not be included in the gross income of the beneficiary. And paragraph 1 shall not apply to any qualified rollover contribution. So yeah, those are all fine. Rollovers are clear as far as those additional taxes. And 529AE6, okay, distribution excess contribution. So if you put in too much money, in the case of any contribution which is made before the calendar year in which the account beneficiary attains age 18, and which is in excess of the limitation in effect under Section C2A, which is that 5,000 plus inflation, paragraph 1 shall not apply to the distribution of such excess. The amount of such distribution shall not be included in gross income, and the tax imposed by this chapter on the distributee for the taxable year in which the distribution is made shall be increased by 100% of the amount of the net income attributable to such excess, determined without regard to subparagraph B. So that is an important loophole closer right there. So what this is saying is that if you put in too much money and the trustee, let's say you set it up with Schwab, they send you that money back. If you make any gains on that money while it's in the account, then you're going to lose all the gains. They're going to take that as a tax. This forces all the trustees to not accept excess contributions. So they will automatically send it back to you, which is what they do with IRAs and whatnot. If you over contribute, they'll send you a check back. So I've seen this in cases where, when you get closer to retirement, you get an extra booster to your amount to be able to contribute to IRAs. And we had one case this past year where somebody had put in an extra $1,000, which they were allowed to, and the trustees sent them that money back. And they said, this is an excess contribution. And we would say, no, it isn't. We are within the age range that we're allowed to contribute $1,000. And they said, oh, okay. I fixed it. But it's these kind of little niggling details that you got to make sure you have tightened up, both in the legislation and on the actual trustee accounts themselves. So treatment of deaths of account beneficiary hopefully never has to come up. But in that case, if they die before they attain age 18 over that calendar year in which they would have, any person acquires the account beneficiary's interest in the Trump account, paragraph 1 shall not apply. Such account shall cease to be a Trump account as of the date of death. An amount equal to the fair market value of the assets reduced by the investment in the contract in such account on such date shall, if such person is not the estate of such beneficiary, be included in such person's gross income for the taxable year, which includes such state, or if such person is the estate of such beneficiary, be includable in such beneficiary's gross income for the last taxable year. So beneficiary qualified. Oh yeah, so that covers the treatment of death. So if this gets, voided because the beneficiary, passes away, then it flows through as though it were taxable, which is, not ideal, but all right. Qualified rollover contributions. For purposes of the section, the term qualified rollover contribution means amount which is paid in a direct trustee to trustee transfer from a Trump account maintained for the benefit of the account beneficiary to a Trump account maintained for such beneficiary only if the amount of such payment is equal to the entire balance of the Trump account for which payment is made. So again, this is reiterating that you can only have one, right? So you can transfer from one to another, like if you want to change trustees, you want to go from Schwab to E-Trade, let's say, but it's got to be the whole thing. You can't do a partial. Qualified general contribution. Come back to that later. B is made to the Trump account of an account beneficiary in the qualified class of account beneficiary specified in the general funding contribution. And C is in the amount which is equal to the ratio of the amount of such general funding contribution to the number of account beneficiaries in such qualified class. Okay, so not a whole lot actually matters in there, but the general funding contribution means contribution which is made by an entity described in section 170C1, other than in possession of the United States or political subdivision thereof, or an Indian tribal government, or is an organization described in section 501C3, and which specifies a qualified class of account beneficiaries to whom such contribution is to be distributed. So basically what this is doing is this is creating a mechanism by which other entities like, states and charities and things like that can contribute to potential Trump accounts. The qualified class is all account beneficiaries who have not attained age 18 before the close of the calendar year in which the contribution is made, which is the same. All account beneficiaries who have not attained the age of 18 before the close of the calendar year in which the contribution is made were born in one or more calendar years specified in the terms of the general funding contribution. Okay, that's fine. Still, if you're in the right place, you have a social security number, you're under 18, you should be fine. Qualified geographic area I thought this was interesting. The term qualified geographic area means any geographic area in which not less than 5,000 account beneficiaries reside and which is designated by the secretary as qualified geographic area under this subparagraph. If there are any, then you might not be. Trustee selection, customer service, history of reliability, regulatory compliance, all that kind of stuff. It's going to be the big brokers. That's just how it is. Other special rules in coordination with individual retirement accounts, which is IRAs. Subparagraph, the rules of subsections K and P of section 408 shall not apply to a Trump account, and the rules of subsection D and I of section 408 shall not apply to a Trump account for any taxable year, beginning before the calendar year in which the account beneficiary attains age 18. So this is just exempting certain sections, right, of the IRA because it's not really an IRA, not yet, right? Because it's a special thing that we're being stated. So they're just carving out, like, penalties and treatments and that kind of, because those are being overridden by this new section. Custodial accounts, so they're adding a section, contributions in the case of any taxable year beginning before the first day of the calendar year in which the account beneficiary ages 18, contribution to a Trump account shall not be taken into account in applying any contribution limit to any individual retirement plan other than Trump account. So basically you can do both is what this is saying, which is great. Let's say you are a 16-year-old and you have a job working at wherever, and you want to put money into the Trump account and you want to put money into the IRA, and you can. So that should be fine. So distribution section 408D2 shall be applied separately with respect to Trump accounts and other individual retirement plans. Again, segregating the two things because, different rules for different things, which is fine. Again, excess contributions. This is on the trustees. So this could be the brokerage houses. They have to do reports and all that kind of stuff. Same kind of thing that we typically see. The trustee shall have to make a report about rollover contributions. The period of reporting, this I thought was interesting. Subsection shall not apply to any period after the calendar year in which the beneficiary attains age 17. Able rollover contributions exempt from able contribution limitation. So you don't have to double count the numbers if you're contributing to an able account, which is fine. And so then we get into other stuff, which I thought was super interesting. They're creating a new section, section 128 of after 127. So section 127 is what dictates the ability of employers to contribute to educational programs of their employees. That was amended during COVID to include student loan interest. So if you go back, and I've got a blog article about how you can create a tax-free benefit to employees up to $55,250 going towards their student loans, which is great. But they're adding this now. So gross income of an employee does not include amounts paid by the employer as a contribution to the Trump account of such employee or any dependent of such employee if the amounts are paid or incurred pursuant to a program which is described in subsection C. Okay, so what does that mean? Well, that means that this is a new employee benefit that employers can offer. Obviously, it's going to kick in 2026 because, the whole thing's going to kick off July 5th, 2026. So if you're an employer and you want to offer a tax-free benefit to your employee and to your employee's kids, then you can do that. And it's going to be deduction for the business, but it's not going to be taxable income for the employee or the employee's beneficiaries. So if you're employing minors, for example, this would qualify. But if you're employing people who are not minors, but who have minor dependents, because, or of any dependent of such employee, then you can do so, which is fantastic. So in general, the amount which may be excluded under subsection A, which is what we just talked about, with respect to any employee shall not exceed $2,500. Okay, so here's a new $2,500 benefit that you can offer to all your employees. Inflation adjustments, in the case of 2027 and afterwards, the amount shall be modified by inflation adjustments rounded to the nearest $100, yada, yada. For the purposes of this section, a Trump account contribution is a separate written plan of an employer for the exclusive benefit of his employees to provide contributions to Trump accounts for such employees or dependents of such employees, which meets requirements similar to section 23678 of section 129D. Okay, so you have to have a written plan. Great. Okay. So the certain contributions to Trump accounts, gross income of account beneficiary shall not include any qualified general contribution to a Trump account of the account beneficiary. And any term used in this section, which is used in section 530A, shall have meaning given such term under section 530A. Okay. Now, we have the pilot program. So this is the free money section. So, in general, in the case of an individual who makes an election under this section with respect to an eligible child of the individual, such eligible child shall be treated as making a payment against the tax imposed by subtitle A for the taxable year for which the election is made in an amount equal to $1,000. Refund of payment. The amount treated as payment under subsection A shall be paid by the secretary to the Trump account with respect to which such eligible child is the account beneficiary. An eligible child, it means qualifying child who was born after December 31st, 2024 and before January 1st, 2029. Okay, who is a United States citizen, has no prior election, etc. Social Security number required. Okay, so what does this mean? It means kids born 2025 through 2028, which is the same phase out thing that we've seen in a lot of sections so far, are going to be able to get a refundable tax payment. Refundable means that even if you don't owe tax, you can still get that money deposited of $1,000 paid into this Trump account. So if you have a newborn, anytime in 2025, 26, 27, 28, the government's going to give that kid a $1,000 kickstart to this whole Trump account structure. So you don't have to put any money into it. You can still get $1,000 put into it. Now that money is locked up until they turn 18. Okay. So that'll be interesting. And how many kids are born every year? I don't know. A few million, right? In fact, let's take a look. Let's see. How many children born in us in 2024? So let's see, 2024, 3.62 million babies. Okay. So that's going to mean that the government's going to kick in $3.62 billion. And, it's going to be slightly different every year, right? But $3.5 billion paid into these trustee accounts, potentially, assuming that people make the election. I don't see why you wouldn't. And that money's going to go into the stock market, essentially. All right. Penalties for negligent claims or fraudulent claims. Yeah, don't do that. And, got to have social security numbers, etc. Yeah, this is all what goes wrong if you don't do things correctly. So obviously the trustees, which again are going to be the brokerage houses, are going to have to do their due diligence to make sure somebody is qualified. They are, born in the right time periods, and they are U.S. citizens and have social security numbers and so on. So that part should be fine. I don't expect too many penalties coming out of this. But yeah, that's the Trump account. So essentially, we are creating small stock market investment accounts because they're all going to be either mutual funds or ETFs. They're going to be able to be funded up to $5,000 a year. If they're newborns in this 4-year period, they're going to need an extra $1,000. You can create employer contributions, which is really powerful for people who have employees, or if you're an employee, under like an S corp, of your own S corp, so that's pretty great. They can be open for anybody under 18. And, if you already have children like I do, my kids are, tweens right now. And so I'll be opening accounts for them once everything opens up in July of 2026. And you can be sure I will be taking an employee benefit, a tax-free benefit for there. That's a $2,500 tax-free put into their accounts. So it is under the IRA structure. It converts to an IRA when they turn 18. And, one thing that's not in here is all the stuff about the businesses, which we saw in previous versions of the language. So we also saw different age cutoffs in previous versions, which are gone from here. Part of the difficulty of tracking legislation impacts over time is that things change, right? Congress changes their mind about what is going to be in and what is going to be out. So under this final version, anybody under 18 can open, which is great. And so this is going to be, for the people who elect into it, this is going to be a very powerful savings strategy and investment strategy for those kids. Because if you put in, let's just say a newborn, right? So $5,000 a year for 18 years or 70 years, then, that's going to be, $85,000 worth of contributions. And if you're able to leave it alone, then, that's going to grow up to be millions of dollars by the time they reach retirement age. If you do end up tapping that amount for education or whatnot, then that'll obviously impact the growth, but really powerful potential here. And I will be doing a lot of calculators and spreadsheets that will end up calculating what you might be able to get from these accounts. So again, starting July of 2026 is when this all goes into effect. And we'll see what the different trustees offer in terms of the account structures and what funds they offer inside, because we know S&P 500 is defined explicitly, but what else is going to be defined under that, generally US companies and, has regulated futures contracts and all that kind of stuff. So which big indices are going to be allowable? So that is still to be determined, but I'm looking forward to it. And, this also, creates, that potential from the employer side about that $2,500 benefit that they can offer to employees. And, if you can spare the cash flow, I would say, absolutely go ahead and do that. All right. So that does it for Trump accounts. And next time we will be on to chapter 3, which is establishing certainty and competitiveness for American job creators. It's a whole lot of business tech stuff. So we'll see what that section holds. And until next time, I'm Neal, Texture.